presentation is presented to you from my company called The Wealthy Engineer. And what we do is we engineer your future so that together we are more. And this is one of the strategies that I've gone into in the last 2 years from the silent partner side. So I'm going to share with you guys that strategy. And this is allowing me to have infinite return and create generational wealth. Okay, so as most of you guys know, I'm already a retired engineer. So this strategy allows me to continue that at a bigger scale. Okay, so, you know, even if you're not an engineer, this strategy will work for you. Okay, so if you stay until the very end, I do promise that you will get a bunch of gifts that are worth over $500. Okay, and if nothing else, you will learn something new potentially, or be reminded of something that you already knew and can maybe hear it in a different way and implement it. So let me share with you some of the gifts that you will get. And I will dump this into the chat box for you so you guys can just go right ahead and get access to all this stuff. Okay, so you get access to the Academy, which is 25 years of my brain on videos for you to go and learn all the stuff that I know, right? Along with getting access to my Path to Mortgage Freedom book. So you can actually learn how to be mortgage free in 10 years. And this is the same strategy that I used to pay off my student loan, $50,000 in student loans in 2 years. And I did that fresh out of university. So you get access to the book and the course. Also a call with me if you want to talk about this or any other strategies, along with my private lending document and the training that I did at the beginning of the year. And this private lending document and training is one of the ways that I am making over $8,000 a month, very passively through private lending. Okay, and you get access to those trainings and the private lending document, just for being here, okay? So we did a session by the Wealthy Engineer about 1.5 years ago where I presented this strategy. Okay, so if you haven't had a chance to watch that yet, I will include a link to the YouTube channel so that you can watch that 1 hour recording. And that's where I talk about the strategy and how this infinite return strategy came to me while I was hiding on an island during this whole COVID thing. Okay, so, over the last 6 months, things have been opening up again. And it almost feels like COVID never happened, right? And it would be really sad if we did not learn that through COVID, that our family and our health is the biggest, most important thing, right? And so that's one of the reasons why I'm sharing the strategies, because I'm not, I'm really not selling you guys anything, okay? I'm giving you this information. It's purely educational. During the last time that I did this presentation, somebody actually said to me, Hong, why are you doing this presentation? Like, why are you just giving this information out? And the reason is because I've been able to retire from engineering. I'm able to get my passive income and live the life that I want to live. And so I really want to just pass that knowledge on. And you can go off and you can completely do this on your own. Right? There's a lot of real estate investors on this call that you could partner up with and do this exact same strategy, right? And you can go do it on your own, or you could have a call with me and I can, show you a little bit more of the strategy and how to implement it as well. Okay, so if you have any questions, feel free to type them in the chat. I will address them throughout the presentation and definitely at the end. We are blocking some time off to answer any of the questions that come up, as well as you can also always take advantage of having a one-on-one call with me if this is something of interest to you. Okay, so we have about, an hour together. So, please focus on just this time, because there could be one piece of nugget that I give you that will allow you to retire early, that will give you that financial freedom that you want, right? This one strategy could just give you $5,000 a month in passive income, right? And that is enough to get you to your financial freedom if you want, okay? So, and that one piece of nugget you could potentially miss if you're multitasking, Okay, so this is a family-friendly conversation. So please, if your kids are in the background, please, have them listen in. Like I have my kid listen in on a lot of my calls because I do want him to learn all of these principles as I'm learning them as well and sharing them. So it's totally fine if they're listening in. Okay, so, during the time that we're together, I'm not going to talk a ton about my portfolio, my journey, who I am, and how I was able to retire in my 40s. Like, you can go to the last video and watch all of that stuff. Okay, so what I'm really wanting to spend this hour on is focusing on sharing the strategy about infinite return and how I'm doing it. So, so if you look at the right-hand side of that, of this picture, in 2020 was when I had this idea, like, oh my God, I could invest with other people, partner with other people, and do equity joint ventures. So that's the strategy that I'm going to share with you guys on how I'm doing it from the investor side. Okay, and some of you guys are from the management side on the joint venture side. And so we'll talk a little bit about that so that everybody's on the same page as to how this strategy works. And that was when the light bulb went off for me, right? Like, even though joint venture partnerships have been going on forever, it really just hit me in 2020 that I don't have to do this on my own. I can partner up with other people. I can put my money into a deal and do zero work. And that's the part that I love, right? Like, not having to deal with toilets, taxes, tenants, trades, and getting a ton of time back while my money is working. Okay, so this strategy allows me to put my money in and then get return forever. Okay, and I'm going to draw that out a little bit more and explain why it's infinite return, even though I'm putting some money in. Okay, so the strategy that I'm going to be sharing with you guys will allow you to have your salary do more than one job. So throughout this slide, I have the word engineer. So if you're not an engineer, just replace that word with whatever profession you're in, okay? So you want your engineering salary to have more than one job, right? So that money comes in, it's paying for your living, your life, whatever, right? But it could be doing more than that. So that's why I'm saying, like, your dollar has two or more jobs, okay? So you're engineering your future and providing for generational wealth and infinite wealth. Okay, and this strategy allows you to do that. Okay, so if you can follow me through on this concept, you're going to be able to continue working in your full-time job if you want to, and make additional income. And you'll have options to either retire early if you want, work part-time, or go on as a contractor, and you want to be there. Right? That is the choice that you have. That's the options that doing a strategy like this will give you. Okay, so just a legal disclaimer that I have to put out there. Okay, this strategy works for me. It may not be right for you. Okay, so before you go and you implement this or run off and do this strategy, please, please, please talk to your lawyers, accountant, other mentors and supports that you have. Get more education, understand this before you go and you implement it. Okay, so just to make sure that we're all on the same page here, the traditional real estate investing is where you buy a property, whether it's single family, multis, you hold it and you flip it or flip it, okay? Then the second part of this traditional investing is that you get the cash flow, you see the appreciation on it, you see the mortgage pay down, and you refinance, you sell it, right? And you make money that way, okay? And the third part of this traditional investing is that either you manage it or you hire a property management company and they manage it. They deal with, the 4 T's, right? So over the years that I realized that there was a 5th T, right? And that's the T of time. Like, I want my time back. I want to be able to do whatever I want during the day, right? And this became really big for me during COVID because I could take, 2 years off and homeschool my kid, right? I had that luxury to be able to choose what I wanted to do with my time. I didn't have to go to a 9-to-5, right? So the new investing in real estate is what I want to share with you guys. So the light bulb hit in 2020 for me that allows me to invest my money in others in a property that they found. They manage it. They put all the tenants, they stabilize the building. They do whatever they need to do to make that property profitable. And I just sit back, I get my money back, and eventually I make infinite return on my money. Okay. So let me just share a couple more sort of at a very high level what joint venture partnerships look like, okay? So in this particular case, you would be the silent partner in part of the ownership of the property. So meaning like you have no say in anything, right? They're not going to call you up to ask you permission for anything. They're not going to call you up to tell you what's going on. You know, the managing side is just going to do their work and you're completely silent. Okay, so if you are a bit of a control person like me, that may not go over well the first time, but that is something that you can actually overly easy come because you realize that you don't need to micromanage them. They're the experts in the industry, right? They're able to do all of that work in exchange for their portion of the equity in the share, okay? So why would you want to do this strategy? Generational wealth, right? This is long-term here. This is not just like a 1-year thing or a 2-year thing, right? It's not a flip. Okay, but the great thing that I also like about this strategy is that you do see some potential income now, like a small portion potentially, right? Depends on how you negotiate all that. So, and when would you like to do this type of strategy? Okay, so it's when you don't have the time to manage it yourself, okay? Or you don't have the knowledge, but you have the money. Some of the deals that I look at, you can get in with as little as 20K. Okay, so of course, there's other things to consider when the entry level is so low, right? So we're not really going to talk about that, but just keep in mind that, you know what, you could potentially do deals at 20K and get into one of these bigger properties. Okay, so in an equity joint venture, you've got two sides. One side is the managing partner, the active people. Okay, those are the people who will bring you the deal and present it and show you the pros and cons and everything. Okay, that's not the side that I'm talking about today. I'm talking about being on the silent investor, the passive side. Okay, so you're sitting there potentially with zero to little experience in real estate. Okay, and I realize like I'm coming in slightly different because I have 20+ years of experience, right? So the great thing about being on the silent partner side is that you really don't need that 20 years of experience, okay? You have the money to invest. So like we said, like 20K, although not recommended there. So usually the amounts would be like maybe 100, 200,000, okay, and upwards. Being part of the silent partner side, the third item is that you don't need the cash flow for, you know, potentially 3 to 5 years. Okay, so if you're an engineer, you've already got money coming in. So maybe that cash flow isn't as important to you. So potentially one thing to keep in mind is that there may not be any cash flow for 3 to 5 years. Okay, one of the deals that I did within 6 months, I got a check, right? So it's different depending on the deals. The fourth item, it's ideal for accredited investors. Now, if you don't know what an accredited investor is, just Google it. Okay, there's so much information out there. You can talk to your accountant about that and they'll give you more up-to-date information. Okay, the fifth thing is that you may be able to benefit from some of the tax deductible expenses. And so that's really from like if you have to set up a corporation, if you have to get legal advice and stuff like that. All of those costs to you is a tax deductible expense, right? And you work with your accountant on how to figure out how to get the most out of that. Okay, so, you know, within this joint venture partnership, as the silent person, you're bringing in a quarter of a pie. So if you think about a whole pie, you're bringing in the money side, okay? Whereas the managing side is bringing in three portions of the pie. if you think of it that way. So in total, then the whole pie, that's the deal. That's the whole package, right? So if you think about it, there's 4 parts: the money that you're bringing in, and then the managing partner is bringing in knowledge, people, and the deal. Okay, so that there's 4 parts there. Okay, so I want to share with you guys this concept of camping, because in real estate, you want to be camping. When you're investing in real estate, you want to be camping. You want to be getting cash flow, appreciation, mortgage pay down, and increasing net worth for generations. So any deal that you look at, whether it's joint venture or any other type of deal, you want to have as much of the camping concept in that deal. Okay, so just to hit this home a little bit, I want to explain this maybe by showing some numbers. Okay, and as an engineer, we love numbers, and I'm hoping that this may shed another way of looking at it. Okay, so let's just say you have $100,000 in cash. Okay, it's sitting in the bank, and there's a deal that is $2 million. That means that to buy the property, it's $2 million. Okay, so this 100K will get you about 10% of equity. Okay, and you might be sitting there going, Hung, 10% sucks, especially with inflation and the interest rates the way they are. A 10% return is crap right now. Okay, so now here's the thing that I want you to think about and see it in a different way. Okay, you get 10% of cash flow, 10% of appreciation, 10% of the mortgage pay down. Okay, so of course, this is after you get your 100K back. You continue to get that 10%. Okay, so that's how you do the infinite return, is that once the building is stabilized, once it's refinanced, your money comes back to you, but you still have equity left in there for the life that the partnership is in place. Okay, so just to give an example here, if this property gives you an annual cash flow of 100K, so after paying all the expenses and everything, there's 100K left over, the appreciation is 1%, and you have a mortgage pay down of $20,000 a month, okay? You actually will make 10% of all that, and you actually make about $18,000 a year. Okay, so imagine having 5 of these types of deals, right? If you have 5 of them at 18,000, you're at 100, like close to 100,000 a year, completely passive because somebody else is doing all the work, and you would have already received all your money back. Okay, so that's the concept of infinite return. Okay, now in this example, we're not even talking about the compounding effect of the appreciation and all of that stuff in running these numbers, right? We're just looking at it as with numbers being very easily explained. Okay, so I'm going to share a deal that I participated in. So I did this deal because the numbers made sense for me, right? It may not make sense for you. Okay, so this is a property in Edmonton called Stoney 44. And Adi is the management side of it. Okay, so I'm going to have Adi come on and talk through what the management side does and what they bring to the table. Okay, so I will stop my share. And if there's any questions, feel free to ask it. I will stop my share and then let Adi bring your slide up, and you can explain what the management side brings to the table with Stoney 44.
Can I ask a question, Hong?
Yeah, of course.
You showed a $2 million deal and $100,000 got you 10%. How did that work out?
Sorry, let me see here.
Should that have been 5%? Just curious.
Sorry, go.
I can actually answer that.
Okay, thank you.
So the assumption on that slide will be like 50% will be equity and 50% will be debt. So on the equity side, that's 10%. So we contributed 100K to $1 million because the deal is to 2 million. So that means equity part portion. will be $1 million. So if you contributed 100,000, that will give you 10%. Does that make sense?
I'll have to think about that.
Okay.
No, and if you're looking at it from the entire deal, that will be 5%, like you said. But if it's about the equity contribution, that will be 10%.
I'm just thinking, if you're the person just giving the 10%, giving $100,000 on a $2 million deal, just as a silent partner, then you're only silent for 5. You only have 5% involved in the deal. So that's why I was kind of wondering how you got 10.
Okay, we can talk about that later. Yeah. I don't really understand your question. Yeah. Oh, thank you. Thank you. Hi, everyone. Nice to be here. So the question you're asking on about what the general partner, what they bring to the table, like you mentioned in your slide, we talk about the knowledge, the deal, and the people, right? So, and that is what we bring in on our deals. We have the knowledge, we have the deal, and we have the people. So we have to look at sourcing the deal. So you have to look for the deal. You probably have to go through, I don't know, at times you go through about 50 deals before you find the right one. You know, so we're constantly looking for deals, looking at the management, you're looking at the environment, not just looking at the deal. You have to look at the environment. Is it a safe environment? Is it safe where you're going to get your return on investment back? So these are all the things. You have to look at the property management, company that you're going to work with. You have to look at the general contractors. You have to go do the due diligence on the deal to make sure that the numbers work. You have to do due diligence on the environment of the building. Is it a safe environment? You have to do your due diligence on everything, including the building condition, to make sure that the building is in the right condition. And you don't want to buy a building and a month or 2 months or even a year later, realize that, okay, the building probably sinking. So those are kind of knowledge that and at the same time, the general partner has to source the debt, and you have to guarantee the debt as well. So that is the concept of this being a silent partner. As a silent partner, you don't have to sign on to the mortgage. You don't have to go to the bank to look for mortgage. You are not underwriting, you're not guaranteeing the mortgage. That's the headache, and that's the job of the general partner. That's what they bring to the table, part of what they bring to the table. And even on the side of the equity part as well, they're still gonna put together potential investors that are gonna invest in the deal. You have to bring everybody together and make sure that everything is being done according to the law. Because if you're doing a deal, you need is guided by the securities law. So you have to make sure that you're complying with the law. And that's kind of knowledge that the general partner brings to the table to ensure that investors' money are safe. So like the deal that I was talking about, this is the 44 units in Edmonton that we recently closed on. So we did the due diligence, we look at the deal, we underwrite the deal. Okay, that's after looking at over 20 deals. And this was one that didn't actually pencils out. And so, okay, and we move on this. And we're able to buy this less than the ask for about 20%. And when we reappraised it just about 2 months after, it shows that we actually made money on the acquisition. And these are the kind of knowledge that the general partner brings onto the deal, being able to make money on the buy, that you're buying less than what the property is actually worth. So like I mentioned, in this case, we bought it at 4.8 or approximately 4.9, and we're able to reappraise it just 2 months later, and we came out at 5.3. So which it shows that we made about 475 just on the buy alone. And at the same time, when the knowledge of the general partner in this case is being able to know when to go to the market, probably to refinance. And most people say, oh, the interest rate environment is so, is so choppy and everybody's scared. But we're able to refinance this deal just in the midst of all this madness with CMHC, and we're able to lock in for about 4.1%. But in the current market right now, people are paying about 6-7%, but we are paying just over 4%, able to refinance it and lock it in. The time for this deal for 5 years for this. And this is part of the knowledge that we bring to the table in terms of renovating the property. As you can see, I'm probably going to show you the next slide. Our value enhancement plan is to look at the exterior first, because that's what appeals to everybody, the curb appeal, before you even move into the property, before you go inside the property, is the attraction. The attraction comes from how the building looks on the outside before you even think about going inside. And this is how we implement our strategy. So you can see this is when we bought the property, it was this color, and but we felt, okay, how do we have to stand out? We need to stand out to be able to attract the kind of tenant, high quality tenant. And we said, okay, we agreed on this color and we choose to use this color, and can see that it's totally different. And even on the street, it's totally different. It's like a unique property that was never there before. And we started the renovation work. You can see this is how it was when we acquired it. This is where we are right now in terms of renovation work that we've done. These are the knowledge that the general partner brings to the table. Same with the kitchen. You can see the kind of gas that was there, the kind of cooker that was there, and the chef. Everything we've done, we've replaced all that. We are doing the stabilization with the renovation work that's being done right now. And same thing in the bedroom. It's totally new building. So you can see the even from the entrance as well, the way it looks now and the way it was when we acquired the property. So in terms of location, we're always looking at property that we know that, okay, you have, because what we typically look at is affordable buildings. We are not in the building of luxury. So we look at affordability and we look at proximity of those buildings to job areas, to grocery stores, so that people is within walkability and people can easily just, go to the grocery store or be able to walk to work. So those are the kind of places that we look at when we're looking at this kind of deals. Like on this deal, for instance, or the equity on this deal was 1.2 million, and we're able to close on that. We have just one spot left for that on the 130,000 that we're raising on this particular deal. Ong, if you have any questions, so I don't just keep rambling.
There was a question that came in from Steve Mason. Do you need to be an accredited investor to do these types of work or these types of deals? So do you want to answer that?
Yes, it depends on the general partner, right? For us on this deal, you have to be an accredited investor, and some other deals you don't have to be an accredited investor for that to happen. Mm-hmm. So it depends on the sponsor of the transaction, how they are putting it together. For us, we felt accredited investor is easier to deal with accredited investor because in most cases you want very few people investors. Ong mentioned something about investing 20,000 earlier. The sponsor will probably be dealing with about 50 people or more than 50 people. We're doing 10,000, 20,000, and that's a lot of work, and it's going to be difficult when you're taking certain decisions that you might need to talk to the investors directly. So that's why for us, accredited investors are the people. And in terms of definition, I think Ong talked about it. You can just Google it, and if we have time, I can talk more on that.
Yeah, just to shed some light, like when I look at my deals to invest in, I will always ask, hey, how many people are you looking at raising money from? Because usually if it's 10 or more, I shy away from deals like that because I want to know the other investors. I want to know that, okay, if something goes wrong, that the managing side is going to be able to do the work and manage us investors to make sure that we're not panicking or, that things are a lot more manageable, yeah. Right? Whereas if you've got, even 35 people, right, it becomes a lot harder, right? And then to try and track everybody down to have a conversation, you know, because some of these deals, like in 5 years or 7 years, as a group or as the management side, they're going to come to us and say, hey, we're thinking about selling, or should we just refinance, right?
Yeah.
We, you know, we may have a say in that. And if you've got to get 40 people into a room to vote on that, it becomes a little bit more difficult to manage, right? And the point for me of doing this strategy is that it's not going to be stressful. Like, I'm not going to be worried about where my money's going and whether or not I'm going to be getting my investment back.
In most deals that we do, we only want to keep it the numbers for less than 10 investors, just to, you know, to have a current team that we can always talk to. We can all probably meet somewhere for, you know, maybe for dinner, but you can't put 100 people or 50 people in one room trying to have a conversation like On said. It's more or less impossible. So that's it about this deal that we have for the 4 unit that we have in Edmonton. We're currently stabilizing the property. We've done the exterior. We are moving on the interior right now. We're working on that. So if you have further questions, and for us, we try to keep our options open when it comes to exit strategy. We don't just have one exit strategy, because you have to think about it then, okay, what if this doesn't happen? Because you can't have just one exit strategy. So it's either we refinance, we talk to our investors. If majority want us to hold on to the property, and we have 1 or 2 investors that want to exit, those that want to hold on to the property will look at the valuation. If we are selling it right now, how much would the property have sold for? What would have been the profit? Then so the investor that want to exit get all their money back. Then the profit they would have gotten, suppose we have sold that property, they get that as well. Then that's from the other investors that want to stay. They buy out the investors that want to leave. So it's not a situation where the general partner refinance the property, give investors their money back, and hold on to the property for themselves. We know that's not our play. That's not how we structure our deal. And besides, we're working with one of the best legal firms in Vancouver. So everything is properly documented, and we can't do that. So it's not even allowed. So that's it about Stony 44. If you have any question, I'm happy to answer.
Okay. Adi, do you want to?
Question?
Go on, please.
Who's your lawyer in Vancouver?
Lawson Lundell.
Okay. How are you paying for the renovation costs?
It's part of the money now we raised for the renovation, and the last spot that we have right now, that's what we're doing, using the funds for.
So you got the money for renovations?
Yeah, part of the money we raised was for renovation. We do that from onset. We don't, typically that's what you do when you're raising the money. You're not just raising money for the acquisitions alone. You raise money for the acquisition and the money that you're going to use to renovate. Because the strategy is value add strategy. And what it means is that you're buying a building that's a bit old, but what you're trying to do is to renovate it, bring it alive. It's more or less looking dead, but you can bring it alive and make it more attractive that people want to live in that building again. And that comes with renovating the entire building, not just the exterior, but the interior as well. And the strategy is to do that on turnover. It's not that we're going to kick in tenants out. No, we do that on turnover. Once the tenants leave, yeah.
Okay, thanks.
Yeah, so when I run my analysis to figure out if this is a property or a deal that I want to do, I want to make sure that it's not going to be where there's any cash calls, right? Because then that dilutes my investment, right? Because as an investor coming in, if something does go wrong, or if there's a major renovation that needs to be done, there could be that negative cash call. And that's one of the things that I look at in terms, like when I'm doing my initial analysis, is okay, well, is there enough buffer? Is there enough reserve so that if there's a cash call, like so that there is no cash call, right, within that first 5 years, ideally, right? Steve, you have a question?
Yeah, I was wondering how what sort of things can go wrong, and I guess the cash call is an example of that. And how are those silent partners, their investment protected when something does go wrong?
Okay, so even when you talk about cash call, at times it might not dilute the investors if all the investors decide to contribute, for instance. Well, and in most cases, you try to mitigate that by raising enough money. Or you let the investors know that, okay, what you're trying to do is with raising, let's say, for instance, let's just use the number. Let's say we're raising $1 million, and what we're trying to do is have 5 investors. So if all we've raised is 800,000, for instance, that means there's a shortfall. So the total that we raise is 800. That means 80% has been raised. There's still 20% left. So they know, for each investor, know that they are supposed to have 20%, not 25%, because the entire money hasn't been raised. So that 20% balance, they know that, okay, except if they contribute additional money, then they are going to stay at 20%. So that's how you try to mitigate, make investors know how much is required from each investors and how much are they committing to invest in this deal. This is target we're looking to raise, and how much are you? And upon closing, oh, this is total amount we raised. That means there might be, based on what we raised, this is your current position, but based on that target, this is what you have had in terms of interest, the ownership interest in the deal. Until we raise that entire money, this is your ownership interest based on what has been raised. So that's how we try to mitigate that issue of having capital call. Make sure you have enough reserve when you're raising the money. Make sure you have enough money for the renovation so that there's no capital call. And when you're projecting, make sure that you look at the environment, look at the interest rate environment. What's your strategy in terms of refinancing? Can you get the refinancing done on time, that the little cash flow that you have is not going to consume, take on all the acquisition debt, debt service that you've taken, that you have enough money to service the debt. That helps you in terms of capital call issues.
So some of the other risk considerations would be the location, right? Like, so is this property in a location that is going to keep growing? Is the future value of the building still going to be there? Is there going to be enough tenants who are going to want to live there? So you also want to do your own due diligence on the market and get an understanding of that. So some of the other risk is, so in Central Canada, there's been some managing partners that have in the last couple of years been charged, right? And so that may be a risk when you're doing a project like this, right? And Steve, if you want, like we can have a separate call about some of these companies that have been hit that way, and then what's the effect to the silent partners, right, that come in on these properties, because there is like a trickle effect of what happens there. But just keep in mind that at the end of the day, you have legal documents that does allow you to take some legal action, right? It's not ideal because then there's, stress and energy and stuff like that, which is why doing that due diligence at the beginning as the silent investor is really important. Okay.
All right. Thank you both.
Yeah, you're welcome. Mark, you had put in a question in the chat. Do you want to just ask it, and then Audie and myself can answer it?
Yeah, sure. I was just wondering, actually, with the example that you gave about the last deal you showed ending December 18th, it was saying that you were looking to raise 130,000 and the minimum investment was 100. So I was wondering if that means after that you were going to seek for a smaller investor to just complete that 130 with like a smaller 30,000 investor?
Not necessarily. The minimum investment on the transaction itself is 100,000, but you have investors come in, for instance, 200,000. Oh, for one reason or the other, they couldn't meet up with that 200K. So they said, okay, I can only invest 170,000, and that was what happened in this case. But the minimum amount still remains 100,000. You might not need the 3,000. And the 30,000, we might need it, but the minimum. But of course, we always open to have that discussion. If you want to have a separate discussion on that, we could have that.
Sure. Yeah, I'm on the side of the people that have a bit less to put. I'd be looking for these options. So yeah, maybe a separate discussion would be more suited. Yeah.
Okay, Tommy, I see your hand up. Do you want to unmute yourself?
Hi. So you mentioned that you raised money initially, and did you account for any renovation? I think you did mention you did, but then you also mentioned that you need to raise another 130K for the renovation. So can you please explain why is that?
Okay, I can. So what happened is that when we did this transaction, the market hasn't gone bunker the way it is right now. Part of our strategy was that we refinanced with CMHC, and when we're projecting sometimes in February, March, the CMHC interest rate was about 2%, 2.5%. And since then, that's doubled. So part of the cash flow ordinary from the project itself, our plan was to, okay, we don't even need to raise the additional money. We just use the cash flow from the deal, from the property itself to do the renovation work. So, but as the market is turning, that even the cash flow that it's now that's doubled more or less from 2% to now paying over 4% in interest rates. So we're supposed to pay, for instance, let's say 10,000. Now you're paying 20,000. But there's enough room for that. So we felt, okay, maybe after we do the refi, maybe we're going to have enough cash flow. We don't need to do to raise additional money for that. So when that didn't happen, we just, okay, there's no point. Since we informed the investor from the onset, this is how much we needed and this is how much we raised, and said, okay, maybe when we do the refi, instead of giving us back some of the money, as we had hoped was going to happen sometime when we're going to do refi, this was the discussion we had February, March, but that didn't happen by the time we're doing the refi in August, because the interest rate environment has suddenly changed. Our debt service has more or less doubled. So we still had that spot open. So that's why we said, okay, we're going to go with what we have right now. Just take on one additional investors or two to cover for what we had hoped. We are going to use the cash flow from the property and to do the renovation. That was what happened, and that's why we decided that. We planned for all that, but the market's changed. And when the market changed, you have to adapt to the realities on ground.
Okay, yes, so you also mentioned that you have appreciated or refinanced for 500K, if I remember right?
Yeah, that's correct.
So that 500K doesn't cover up the renovation costs?
When you do appraisal, that is when you're doing a sale. That you only realize that when you're doing a sale. You've done an appreciation saying that is what it's worth, right? So it's not that you're selling. So when you're selling, that you're going to make that money. That's the cash element. So that's why it's an appraisal thing. It's not a sale. Okay, and that was the appraisal we used to do the CMHC. Go on.
Sure. No, I guess my question is, how much equity did you pull out from the refinance?
We didn't pull out any equity in the refi.
Okay, that's why you need the 130K.
That's correct. We didn't pull out any equity because the interest is doubled, as you know. So if otherwise would have probably, so let me just say this. When your interest rate doubles, that means that your LTV more or less is going to shrink. So we are supposed to get an LTV, let's say 80%, because your debt service is a function, your ability to get more mortgage is a function of how much you can service with your cash flow coming from a deal or from a property, right? When your interest rate doubles, that's in this case, let's say you're paying 3,000, now you're paying 6,000, and your total capacity is just about, let's say it's 7,000, for instance. Ordinarily, you're supposed to have excess of 4,000. Now you only have 1,000. So the bank is going to give you based on what the cash flow that you have currently can service. So instead of us getting like about 80%, 85%, we only got about 7% because of the interest rate.
Yep, thank you about that. So how many partners do you have in this deal, if you can share?
Six.
Partners, I would say 6. And they're all aware that adding an extra 1 or 2 partner will dilute the share, and they are okay with that? Or do they want to know they are raise more capital from their side?
No, they're okay with it, and I think I make reference to that initially, that we have a target amount that we needed to raise with 1.2, and this is okay, and we're only able to raise at that point in time about 900, right? And so, okay, if you're going to do the refi, instead of taking money and giving money back to the investors, we're just going to reinvest the money in the deal. That means that interest, instead of having just about 18%, that means they're having over 20%. If we do that. But now they are actually in their right position because we didn't get to do CMHC refi and give them some money back. We had to raise the actual amount of money that we needed. So their actual position is where they are right now. So they are not being diluted. Does that make sense?
Okay.
Or
yeah, that makes sense.
Yeah.
Sure. Thank you.
So just a time check, we are about 8 minutes to the hour. So I'm going to just share my one slide. And then if you do want to connect with Adi, this is his contact information there. If you want to connect with me to figure out, is this a strategy for you and how you can implement this, I'm happy to have that conversation with you. So my email's there. So I am now looking at my 3rd deal right now, which I'm hoping to finish by the end of the month. So if I, like my thought process is, okay, well, if I can get 18,000 a year from one building, and that's, annual going in. And then if I get 5 of those set up, right, that's close to 100,000 a year, completely passive. And then every single year, I'm going to be investing in a new building. So there's always going to be that constant minimum of at least 5 buildings that I'm going to be getting that type of returns from. Right. Does anybody have any more questions about the strategy and, perhaps how I'm doing it and analyzing stuff? Well, Steve, I see your hand up. Do you have another question?
I do. Yeah.
Go for it.
Yeah, what I was wondering is, for people that don't have a large amount of cash available to invest, but let's say they have a large amount of credit, they could borrow against other properties or things like that. Does that sort of investment make sense with a strategy like this, where you would be paying interest on what you borrow to invest in this and ideally getting more interest back in return? Or no, something like that doesn't work so well in a situation like this? It's better to go in with cash with no interest on it.
Yeah, ideally you want to go in with cash, like liquid cash. And ideally you want to come from that mindset that if something went wrong and this money was gone, right, that you're still able to sleep, your family's still taken care of. So if you are using borrowed money from, let's say, a line of credit, you're going to carry that interest rate until that money's paid back, right? Now, for some people, they're okay with that level of liability because they have a high income from somewhere else. And so they're able to, balance out the cash flow at the end of the month, right? When I look at my deals, I look at, okay, well, if this deal goes sour, am I going to have to go back to an engineering job, which I don't want to do, right? And then I look at, like, what's my quality of life going to be if this deal doesn't work out, right? Like worst case scenario, right? So I always try to use my my liquid cash. So now, if you have to borrow money from like a line of credit, you don't want to do it for the long term because your line of credit money or your borrowed money is usually at a variable rate, meaning that like right now, some of our lines of credits are at like 6-7%, right? And so it may not be worth it for you to go through, 3 to 5 years of that interest rate until you're able to pay it back, right? So you want to look at your entire portfolio as an entity and look at how liquid you are in total, not just, hey, you know what, I've got 100,000 here, so I'm going to put it into this deal, right? Like you want to look at your whole portfolio and make sure that you have enough liquidity, you have enough assets building over long term, right? So it's not a flat out no. I'm leaning towards the no, but it really does take a need of looking at your whole portfolio and running that model to say, hey, is it worth it to invest that money into this particular deal? Because keep in mind that once you do a deal like this, your money's potentially locked in, right? Like one of the deals that I did, it's, potentially it's 3 to 5 years, right? Another deal that I did, so normally it's between 3 to 5 years, right? And for some of the deals that, like from my research, some people have, gone past the 5 years and they're not seeing the returns that they want or that they were expecting, right? So even though, when I looked at Adi's deal, I was, they had forecast a certain percentage. There's no guarantees that that's the percentage you're going to get.
All right.
Could get less, you could get
Thanks.
more. So there's no guarantee.
Yeah. So luckily for me, like I've got private money out there that I can always call back in and not fund a private lend deal and put it towards like a debt load, right? Like a bad debt if something was to go wrong, right? So it really depends on what your situation is and whether or not you have other resources of funds to be able to come in to pay off a high bearing interest loan, right? Now, keep in mind that when you do a deal like this, the interest that you're charged is a tax deductible expense. So you could write that off as part of the investment, but it's still not one that I would recommend to do. Like that shouldn't be your primary reason for making that investment.
All right. Thanks.
You're welcome. Okay. Okay, Mark, go for it. Ask your question.
Yeah, I was wondering actually, usually how long is your investment locked in?
It's typically 5 years, but we always have extension period between 18 to 24 months, and I'll explain why that is the case. If you had done a deal in 2017, for instance, and you have a hard lock of 5 years, this is not the best time to sell anything in the market. If you're selling the market right now, you're going to give a discount, right? That's why it's always good to give yourself that room. If the market is hot and everybody's buying right now, yeah, we could sell in that 5 years. But if the market is not in a good position for you to sell, you don't sell, you hold on to it. The market volatility or how the market is behaving, it only lasts for a very short period of time, maybe 12 months or 18 months. Then the market, because the government can afford this noise, they can't afford it to be more than 12 to 18 months. Then they start easing up and people start buying again. At that point, you can actually sell for the price, or you actually sell at the premium. You don't want to sell at the discount. That's why you always want to have that room. So if the market is great in 5 years, you sell in 5 years. The market is also great, you hold on, you talk to investors, look at the way the market is. If you sell, this is much discount you're probably going to sell, probably going to be selling at a loss, or you're not going to realize kind of return that we are hoping to deliver to investors. So give us some room, 12 to 18 months or up to 24 months for the markets to adjust so that we can sell at the what the property is actually worth or at the premium.
So does that mean that the investor's money is locked in until the property is sold?
No.
Not to a large extent, yes. When you do, but once the property is stabilized, you start getting some cash flow, some return that comes on a quarterly basis. In our case, it's on a quarterly basis. But once the property is stabilized, you've finished the renovation work that you've done. You've more or less removed all the kind of tenants you don't want to your building and have the kind of tenants you want to your building in the building, and you can charge the proper rent. That's when it's stabilized, and the excess cash will start coming to investors. And the beauty of this, especially when it comes to tax situation, is that the cash flow that you get based on our structure is not, you don't get tax on it. It's return of capital, it's not return on capital. So you don't get taxed until, if you invested 100,000, until you've gotten all your 100,000 back, you don't get taxed. So you don't get taxed on that return that you get. If it's 5,000, it's 10,000, it's 15,000, until you get all the money that you invested in a deal back, you don't get tax. So after that, you get the tax situation creeps in.
So the other thing that we didn't touch on either was the percentage splits. Like I know that during this call, we were really just talking about like a 50-50 split. But in some of the deals that I'm looking at, it's not always 50-50. So you do need to check that. Like in one of the deals that I was looking at, it was an 80-20 split, right? So 80 for the investors, which is great, and then 20 for the silent partner, sorry, the working partners, right? So the percentages can change. And then that, of course, will affect your analysis that you end up doing to see if it's a deal that you want to do.
Yeah.
All right, so we are 3 minutes over. So, so great job, Adi. So if you have any more questions that come up, especially over the weekend, just let this strategy sit with you. And if you have any more questions, please feel free to reach out to myself. I'm more than happy to, to continue the conversation. I put in all the free gifts into the chat box. So hopefully you're able to get all of those. And then, one of the questions that came up was, okay, well, Hong, you know what, I may not have all the cash to do this. Well, you know what, there's other ways to get the cash if this is the strategy that you want to do, but there's other strategies as well that may be more favorable in your financial situation right now rather than doing this one, right? And so that's something that we could potentially talk about too, to like help you at least start getting that chunk of money to be bigger so that you are able to at some point get into this strategy if you want to. Okay, all right. Thank you, everybody. I really appreciate you guys taking the time out of your day and spending it with Adi and me. And yeah, thanks very much.